All right, ladies and gentlemen, welcome to Forum B. This is Bitcoin, Brexit and bots, the investment outlook for the year ahead. I'm going to begin as usual with a little bit of housekeeping. During the session, I'm going to encourage you to share your views and opinions by participating in the live poll and by asking questions either at the end or even during the presentation. And you can either do that through the AIST Cmsf app or in the good old-fashioned way, raise your hand. If you are going to use the app, please ensure that you select Forum B under the polls and live Q&A.
Otherwise, the other sessions will get some interesting questions.
Which is, I think, where I directed my questions yesterday. So let's move on to the subject matter. By taking the pulse of the room with an audience poll question. Details on how to vote should be on your screen, but the question is, do you think technology and automation will destroy or create jobs? Choose one if you believe that it will destroy jobs, 2 if you believe it will create jobs, and 3 if you believe in fence-sitting and no change.
That's good.
Question. Very good. All right, so while we wait for the votes and the results of the votes to be compiled, let me set the scene for today's forum. Today's forum is going to span quite a wide set of issues that are likely to affect investment markets in the year ahead. First of all, we have the Brexit saga. It will certainly be an issue in the year ahead. What is the likelihood of Brexit actually happening? And if it does happen, will it be a smooth transition for the UK and Europe? The second issue that's likely to affect investment markets is central bank policy. As central banks move to unwind 10 years of easy monetary policy, what exactly will be the consequences rather than the theoretical consequences as predicted by economics? The third point is that inflation has gone AWOL globally. As central banks attempt to increase interest rates, the question is, will inflation actually reappear? This is what central bankers hope will happen, but hope is hardly a good investment strategy. And finally, technology will, without doubt, also feature heavily in determining the investment outcomes in the future. There will be winners and losers. Disruptive technology, such as blockchain, which is the platform on which Bitcoin is enabled, such as autonomous vehicles, for example, those disruptions may result in mass job losses, And that, of course, poses a big political problem for the government. So let's have a look at the results of the poll. About a third of you believe it will destroy jobs. Roughly half of you believe it will create jobs. And pleasingly, only a relatively small number of people think that it's going to create no change. Certainly food for thought, David, as we go through. And so with that backdrop, it is indeed my pleasure to introduce David Garis, who is Director of Economics for Markets Business at National Australia Bank. David's brief bio can be found in the conference app, but I thought it was pertinent to highlight that earlier in his career, David spent a decade in Canberra, culminating as Senior Economic Advisor to the then Prime Minister Bob Hawke's Department of Prime Minister and Cabinet, which suggests he's well qualified to consider both the economics and political forces that may shape the investment markets ahead. Please welcome David.
Thank you, Sam. Indeed a pleasure. Really pertinent issues that you raised there, and no doubt I'll speak a little bit more of that as the session unfolds. But it's been interesting for me that, after I graduated, a lot of the jobs were in Canberra at that time for people in my profession. So I found my way up there, and I think I did about an 8-year apprenticeship in the Federal Treasury. So it was something like, in my profession, the School of Hard Knocks, where you learned about process, you learned about critical thinking, you learned about making sure that your analysis was up to speed and up to scratch. And then a couple of years in Prime Minister and Cabinet, where I learned about the political process. In those days, Treasury was, unless you were the Secretary to the Treasury and you spent a lot of time in the Treasurer's office, you were really quite divorced from the political process. I'd say my sense today that's changed a lot. So I learned a lot about the political process, and life changes, and we moved into the banking sphere. And what a wonderful journey it's been. I guess my job now is to understand what's going on in the economy and trying to get a lead on what the numbers are saying and what that might mean for markets in our conversations we have with our clients. So at NAB we have a fantastic business franchise, and I spend a lot of my time out there talking with clients, trying to find what's going on. In fact, I've been doing a lot of data talking inside the bank as well, trying to understand what our data can actually tell us about the economy, because I think as economists, macroeconomists, we've become a little bit frustrated with some of the official data sources. So always trying to understand both from the anecdotes we've been getting back from business and also from our own internal data. And hopefully there'll be news on that front in the weeks and months ahead. Anyway, that's an interesting journey itself, the big data. I thought I might set the scene. My most important slide, of course, is we all know about compliance.
Right.
So, look, I'm just giving you very general economic information, and nothing like personal investment advice. Never listen to an economist for personal investment advice, Sam. I guess when I'm talking to people, one of the things that they tell me is, we're getting to this, you raise this point of wage inflation or the absence of inflation. And central bankers today have been groomed on the well-worn path of dealing with high inflation. If you go back to the times of Paul Volcker after the big oil price rises of the 70s, dealing with high inflation, breaking the back of high inflation, increasing interest rates, and we've had a somewhat upside-down world in the past decade. So we've had Bernanke, through 3 phases of quantitative easing, central banks buying government securities aggressively to support markets. And of course, we've been thinking as student of economics, I go back to Keynes' general theory and the so-called liquidity trap, that the idea that you can stimulate the economy, but if the demand for money isn't there, it's like pushing on a piece of string.
Right.
Now, how does negative interest rates work, all that? So people are looking at what's been happening on the consumer space as really a soft edge of the Australian economy, the absence of wage inflation. So we were talking before about when Phil Lowe says you better get out there and you better ask your boss for a pay rise. So I walked into my boss's office the next day and I said, right, I want a pay rise. I couldn't really tell you the response that I got at the time, but it didn't actually meet all of my expectations. So that's the world we live in. It's interesting, I'm tracking best as I can how consumer spending is travelling, because you hear a lot of talk about consumer sentiment on the defensive, higher levels of household debt, which makes you wonder if people are so defensive and worried about the future, why have they been going out and buying houses at inflated prices, which is an interesting conundrum in itself. We actually are seeing some growth in consumer spending, and it's been growing at about a per capita real rate of 1.25%.
So is the main driver there easy money?
That's been part of the story. So when you actually,
low interest rates.
Absolutely.
Right.
So when you look at the level of household debt, you actually look at debt servicing and the like. It's actually at moderate levels. And you look at the sort of process that, despite all the talk out there about easy money, the process that people go through to get a home loan, the affordability tests and the like, people actually have gone through this, stricter LVRs, affordability, interest rates and the like. So there's a little bit of comfort there, and surprisingly, if the ABS numbers are right, a bit of a decline in savings. So, and the debt that we have seen has not been in credit card debt, that's actually been declining. So people have been relying a little bit more on mortgages. Interesting, not equity withdrawal, but key to this consumption part of the economy is really two things: the employment outlook and the wage outlook, right? The employment outlook has been very, very strong, unbelievably strong in this world of rapid change. We published a survey earlier this week on Tuesday. We've been doing that survey since 1989. It's a survey of businesses. And if I came here this morning and said to you the economy is booming, it'd be interesting to do a poll on whether people believe that or not.
But is that economy booming statement that you may have made, would that have been driven by business confidence?
It's interesting. So we asked businesses 3 questions. 1, is your trading going up or down? 2, is your profitability going up or down? And 3, what about your employment levels? Are they going up or down? We asked separately about confidence. And the confidence question has actually been lagging the reality on the street for businesses. So as an economist, I would look at this level of business conditions, which is a metric of growth out there in the economy, and it's printed actually at a record level.
Okay, but is there a difference between the way businesses see the economy and the way consumers that are integral to that economy see the economy? So why is there that differential?
Well, it's interesting. It's been very, very a business services driven growth in the economy rather than a high wage consumption growth economy. It's been a very business oriented economy. So business confidence actually above consumer confidence right now.
Right. Okay.
And that's been the case for a little while.
Right. So the spoils of what's happening in the economy are going to business,
Absolutely.
no ends, rather than through wages to employees. So
Yes.
why is there an absence of wage inflation?
So it has to do with more shorter-term factors. It has to do with the cycle, and maybe it has to do with the long-term structural factors. So if you break that down and unpack that, the shorter term has been that, when we went through that mining expansion boom from about 2009 until 2012-13, that drove a big increase in wages, particularly in Queensland and WA, with spillover effects in the east as well. And of course, we've been through the downside of that, and the high levels of unemployment have been high, and we just haven't come out the other side of that process right now. But it's changing.
Okay, look, I hear that, and that's painting a portrait of the domestic economy. But as investors, we're investing, across planet Earth,
Yes.
and we don't have wage inflation pretty much anywhere on the planet, and they didn't have a mining boom necessarily. So how do you explain a lack of wage inflation across the board?
So central bankers, if I was Jay Powell or Mario Draghi, they would say something like, well, Jay Powell would say, we're only now at a point where we're at full employment or a little bit beyond full employment. And as economists, we understand that wages and prices follow the cycle rather than lead it. So we're not yet at a point where we can statistically test whether digital disruption and those other changes, which are real and going on, the degree to which that's holding wage inflation back. But I'd say the next 1 to 2 years, we'll have a better handle on that, particularly in the US, which is probably closer to that frontier than, say, Europe is.
All right, so I just want to make sure that I'm not putting words in your mouth. We are unlikely to see wage inflation over the next 12 to 24 months.
So globally, the US businesses are reporting that small businesses are reporting actually now that they're increasing compensation and plan to increase compensation. To this point, The other thing is that the GFC left a big change in mindset in businesses, that they had to focus on their cost and internal efficiency. And I think that's persisting to today. So that's probably lengthened the lags at least through this process. But you're absolutely right. Nothing central bankers would love even more would be a bit of inflation, because they know how to deal with that. We've seen it. We actually have seen some inflation. You actually look at what's happened in China. You know, the cost of doing business in China has increased tremendously, and we've seen base metal prices push up, iron ore prices, coal prices. So in the goods sector of the economy, you actually do have some inflation. In the labour markets, we haven't seen it yet, but is that a structural change, or is it the cycle is certainly part of the answer? Is it all of the answer at this point?
All right.
So we actually find right now, so what we've done here is map Australia's NAB business survey onto similar surveys that are conducted overseas. It's interesting, the New Zealand line, when I looked at this chart yesterday, I was talking to some beef producers out in Roma. It's interesting to go out there. You know, the presumption is that capital cities have been doing well, but the bush is sort of struggling. Well, agriculture is actually doing pretty well right now. It does vary across sectors, but the New Zealand line has been, I think the election had a sort of a knee-jerk reaction on that, but we would expect that to recover. But you see that the German IFO survey, the US ISM, this is the ISM manufacturing sector, Sam. So this is, let's call it the old world economy. It's actually 60.8 was the reading in February, which was, I've converted this to a comparable statistical basis, you know, to put it on, normalise it at around 0. So actually the highest prints in US manufacturing since the 50s and 60s, since the post-war era. So it's interesting, isn't it, that you could be forgiven for thinking that very, very accommodative monetary policy has at least had some role in that, as well as the true bounce after the GFC. After all, it's only been a decade since, you know, Lehman Brothers in 2008, so nearly a decade on from the GFC right now. So the business reality around the world is that conditions are pretty good, and the similar wage inflation story has absolutely been translated elsewhere. Of course, in Europe, you have higher unemployment rates, so they're behind that on a cyclical view. So, as well as the ABS measures of wages, we spend a lot of time trying to understand from our customers what is actually going on in the wage sphere. So we're looking at not just the ABS measure of the wage price index. So the ABS does, they do a wonderful job. We all know. It's a very synthesised measure of wages. It's so synthesised. You know, when I studied economics, and we had a lecturer who was started life as a physicist and became an economist. Maybe you're a closet economist too, Sam, perhaps.
No.
But if you look at economic statistics, you can decompose them into what's signal and what's noise. And there's always this perpetual argument amongst economists, what's the signal and what's the noise. My view is that the noise actually has a bit of information content in it as well. And what the ABS tries to do with this wage price index is to work out a pure signal measure. In fact, they cut out. It's so smooth that it's not really giving you this sort of short-term indications. So what we do is we poll businesses, we ask them about their labour costs, and you see they've been going up for the past 2 to 3 years. Primarily, we suspect that's not because wages are accelerating, they aren't, but it's really been the employment story. So businesses are out there recruiting. And our survey on Tuesday showed the level of employment at much higher levels. So the short-term indication for employment growth over the next 3 to 6 months is still very positive. That's a very short-term time frame. The other is what are businesses saying to us about recruitment and what's happening as far as job advertisements and what's happening on the Seek website as far as advertised salaries and what's happening in the EBA world. You know, that's all they're all important segments.
Yeah. So these are short-term signals. Absolutely. Nonetheless, right? But
Absolutely.
we'll come back to technology and its rate of arrival in a short while, but I'll just pose the question now, and that is that increasing rate of arrival of technology may, as some of our audience have alluded to, may cause downward pressure on employment levels, greater unemployment, let me be clear, to the point where if that acceleration happens at a sufficiently fast rate, there's almost no ability, I put it to you, to retrain individuals. The NAB itself announced a 6,000 person reduction in its workforce, but it announced a 2,000 person increase in its workforce, but in the technology area.
Yes.
And so none of those 2,000 jobs went to the 6,000 people that were displaced.
Yes.
And I think that equation is a recipe for certainly political turmoil and perhaps economic turmoil, and arguably can be detrimental to the capitalist system, and we're all capitalists here, right? Let's be clear. Look at the businesses we're in,
yes.
right? But there are greater degrees of uncertainty in the period ahead. But if you can come back and address that at an appropriate time.
I think there's a question in there, Sam, for sure. So that's the wage price index, and the Reserve Bank is doing a lot of, you know, if you read the reports, they're talking about wages. They are looking at these high-level measures of wages growth. And as an economist, you might look at those lines and say maybe it's beginning to bottom out, maybe it's not. You know, we've look at the variations in the past. You know, look what happened in 2009, 10. You know, it looked like things were swinging back, and then, you know, the softness in the employment situation, the post-GFC environment. So they're spending a lot of time looking at the micro data, not just the macro data. In fact, that's what I get off on, really, what's happening at the business level. And businesses are saying what they're really focused on is on their bottom line. They're focused on efficiency. I think they are starting to lift their sights and look at revenue growth as well. And if they're recruiting the right people for their organisations. So, you know, I know that when we've done some recruiting, if we can't get the right sort of people, we typically don't recruit, you know, whereas in times past you might have tried to get someone on board, or we might do some internal, you know, retraining and the like.
So if businesses are recruiting, does that suggest that there's no skills gap, or there is a skills gap and the recruiting would be greater if the skills were there?
I think that there's definitely a big skills gap, and probably for all sorts of reasons. The RBA published a very interesting research paper on structural change in the economy, so it gets to a lot of these issues. And the growth in the past 40 to 50 years, and it's been a consistent story. You may be right, maybe it's accelerating right now. They talk about supply chains lengthening. They talk about the importance of business services and outsourcing, and businesses bringing in the real specialists they need to get things done. So you've seen the business sector, you know, was about 20% of GDP 40 years ago. It's actually increased in size. It's as large as the goods producing sector of the economy. So it's like, you know, construction, you know, making buildings and infrastructure, mining, agriculture, manufacturing and the like. So that's seen the very big change in the economy. Just a short term, I'm looking at the very cyclically sensitive parts of the economy and what's happening there on the wages front, particularly in mining and construction right now. I think they're particularly two relevant sectors where a lot of change is happening. In the mining sector, there's a lot of catch-up capital expenditure taking place, sustaining capital expenditure to keep their production levels up. And when you think about things like iron ore production, you know, we're producing exporting 850 million tonnes of iron ore a year now. That was more like 250 to 300 million tonnes less than a decade ago. you think of the harsh environment where that takes place, you need to spend money to keep your mines up to production, the rail infrastructure and the like. And of course, prices for commodities have probably been better than a lot of people expected.
There's not a lot of people working in the mines.
No, but you know what? They employ mining services people to keep their facilities going.
It flows through the economy.
It does flow through the economy. It's not a massive part of the economy in an employment sense, absolutely. In a production sense, in a value-added sense, absolutely it is. What we're seeing there is that, you know, when the mining companies smashed their costs after 2012, you know, these are the numbers produced by the Fair Work Commission on enterprise bargaining agreements. So the latest numbers, you know, have a growth of, you know, 1 or 2% rather than the high single-digit or double-digit sort of rates of growth that you often heard about, you know, when the mining sector was spending money hand over fist. And the other is the construction sector, and I think we all understand what's happening in infrastructure around the country. So this is pressing on the availability of skilled demand right now. So at a time when population is putting pressure on housing demand as well, in an underlying sense. So you've got this competition between population growth pressuring housing demand and yet APRA squeezing the availability of finance. So how do those two things work? And they've had some success in doing that, to the point now where Wayne Byers from APRA is saying that perhaps the 10% investment lending limit has done its work now, and you're starting to see even this week banks offering big discounts, starting to offer bigger discounts on investment lending growth, which had slowed to 3% year on year, right? You know, and construction and development finance.
That was the intent, right? That was the intent.
Absolutely was the intent, and it's been successful. So when APRA starts to say that, you can imagine that credit departments in banks, you know, being looked over their shoulder to make sure they dot the I's and cross the T's, and exactly what's happening.
I'm not sure whether this is an appropriate time to do it, but we're talking about mortgages and we're talking about banks. Can we just turn our attention to interest rates for a minute, right? What is the likelihood that you will actually see interest rates rise in Australia, globally? And if so, what are the consequences for mortgage holders who may have refinanced at 3 and 4%? If cash rates get up to 4 or 5, mortgage rates would arguably be 9 or 10.
Yes.
What are the consequences?
Well, the first point is that we have seen some rise in interest rates in other domains. Of course, the Fed has increased rates from 0 up to 1.25% to 1.5%. And even though they haven't had an acceleration in wage inflation, they still see that as accommodative. In other words, promoting growth in an economy that's already at full employment when you've got the tax cuts coming down the pipe as well. So they're going to push on a little bit more. But let's see with Jay Powell, he's a lawyer by trade. I think he's from what I've heard, seen, he's a very practical guy. He's not driven by blinded adherence to Phillips curves and things like that.
He might just say, let's give it a shot, right?
He may do. I think he's going to be very careful, right? And I think they're getting to the point where they'll need to see signs of wage inflation to push them on too much further than here. So let's see what the various Fed people say when they put their forecasts together next week and publish there. That question about household debt, you know, I've been out at Roma for the past couple of days in Surround. I'd say that's the most commonly asked question. How sensitive are households to increases in interest rates? You know what happens to a borrower when they come in and they say, we'd like to take out a mortgage loan today, and this has been the case for a while now. Excuse me. They say, you know, a bank manager say, well, how much do you think you're borrowing? What, you know, you'd say, well, we think you're borrowing 80% of the value of the house. Do all the checks on the income and expenditure. Not quite what you hear in the press, right? Do the checks, double check.
Right.
80% LVR, providing all those checks are done, the affordability, and it's interesting, the affordability, we're testing borrowers on at least 2.25% mortgage rate higher than the current rate, at least 2.25%.
True, but if cash rates were to go back to normality, whatever that is,
yes,
right? So,
absolutely.
Inflation in the 2 to 3% band causes cash rates to be in the 4 or 5% band, causing mortgage rates to be whatever premium the banks want to make on this, but 7, 8, 9, that's a lot more than 2% over the 3 or 4 that they refinanced at.
It may be, but remember too that the precondition to get to that point is that income growth, it's got to be greater than what it is today.
You need wage inflation.
You need some greater rises in wages.
So let me put it to you that if technology causes job losses and job loss fears, and therefore there is no demand from workers for wages, right? Despite how benevolent the employers might want to be, they say, no, don't give us a wage rise, I'd rather just keep my job. Then without wage inflation and without price inflation, other than let's give it a shot, there's no real reason to raise interest rates.
Yeah, well, that may be the case. When that question that you posed at the start of the session about technology, what I reckon the answer to that is all three.
Please.
And if you actually look at what's been happening to date, if it's any indication of what's been happening in the future, is that absolutely we're seeing big change. So the sorts of jobs that were in operation and even the industries that are in operation 20 to 30 years ago don't exist today. So it's not like that economic historians have never seen structural change in economies. So we have seen that. And jobs have disappeared, absolutely. And the sort of growth we've seen has been in high cognitive business service type jobs. Whether that's the gig economy, IT, or all of those changes, that has been the case, and that continues to be the case today. But the evidence so far, Sam, is even though some industries have been in contraction, other industries have grown from nothing, and that's been sufficient, to this point at least, to create net employment growth. Maybe that will change. Maybe it will turn on its head, and it's going to be quite a different situation. But that's been the evidence to date, anyway. Okay.
I have. I'm happy to take questions from the floor at any stage, but we do have some questions coming in through the app. We'll come back to Brexit because we haven't started. We haven't looked at that yet, but. There was a question on universal basic income. Do you see a role for universal basic income in the future of low wage growth driven by technology? In other words, if technology causes if technology does not result in wage inflation, you get low wage growth, and as you put it, you need wage growth as interest rates start to rise. Do you see that lack of wage growth being supplemented by a handout of sorts via a universal basic income?
I think there is a lot of the two issues that I think that are driving a lot of reaction from Canberra right now. One is things like housing affordability and congestion in the capital cities and all that. And the other is the low wages, the low income growth. That is really finding its home in Canberra right now. So a lot of this is tied up with politics. Of course, politicians can, create some sort of basic income. And I guess that's what we endeavoured to do with the safety net, the social security system and the like. So does that have a role? I think it's certainly got it's got some political momentum right now. Would that be good for the economy and employment? Well, different people have got different views on that. If you ask the employer groups, they'll say that it'd be negative for employment. But I think it's got some political impetus.
All right. If there are questions from the audience about any of the matters that we've discussed to date, I'm happy to take them through the app again. Could we just turn our attention to, we're here to talk about investment markets and the investment outlook. Brexit is a big player in that scenario. What are your views on Brexit, the likelihood, the consequences?
So I have two colleagues in London who are much closer to the action and what's happening there, Sam. My voice is not looking after me this morning. Anyway, so one of those guys is pretty strongly of the view that he's sceptical as to whether Brexit will actually happen. You know,
is he in the finance sector?
He is in the finance sector.
Well, they never voted for it to begin with.
No, that's right. So how do you divine the future for which the rules have not been written, for which the politics are quite big? In one way, Europe has sort of two vested interests. One is there's been so much political capital tied up with the euro and preserving the value of the euro. And even though Britain is not part of the euro, being part of the EC, their strategy is to keep that political capital tied together so that it doesn't unravel. The chances of that happening now probably are preserving it a lot better than 3, 4, 5 years ago when the Eurozone economy was a lot weakened and where political events like what we saw recently with the Italian election and the like, and events in Spain might have well have put a lot more political pressure for change. So they certainly have that objective. The other is, of course, Europe doesn't want this to end badly, and just as they want to preserve the political situation, the last thing they really want is for the UK economy, to have a big backward step, because that could have unknown consequence, knock-on effects, chaos theory, and so forth. I don't know, but what I do see at the moment is they're continuing to buy time. So there's a big European summit coming up, I think, 21st or 22nd, and there's a wide expectation that Britain and Europe will be able to sign what they call a transitional deal. In other words, come March 19, when Brexit is supposed to happen, in other words, the UK to leave the European the EC Customs Union, that current conditions will persist for at least till the end of 2020.
So on balance, you'd say it's that you will get a Brexit of sorts?
I think so.
Right. A question from the audience: if you do get a Brexit of sorts, will that create new or better trade opportunities between the UK and non-EU countries like Australia?
Yeah, it's an interesting one. My father always told me about the changes that took place when UK went into the common market, and Australian exporters lost a lot of markets in the UK. Look, it probably may have positive spin-off effects between Australian trade and UK trade. To be quite honest with you, I'm more concerned about Australia's trade with China right now and the influence of China on Australia's journey. I think that's a big question, but it may well have some positive spin-offs in terms of market access and the like.
Okay, all right. Questions from the audience at all? Okay, Bitcoin is something we haven't addressed. We've touched on technology and disruptive technologies, and of course the blockchain technology which enables Bitcoin and other cryptocurrencies to operate. So maybe we can wrap that all up into one question. There's a set of questions here about whether super funds should invest in Bitcoin. Will that date?
Are you investing in Bitcoin, Sam?
Personally, no, nor is the super fund. No, and I'm not I'm not privy to knowing whether other super funds are or aren't. I'd be interested to know from the audience if you've put the whole chips on black, right? But I mean, you know, we shouldn't. You know, if it is a disruptive technology and the technology has flaws and those flaws get fixed because the purpose of disruptive technology is to achieve some aim that whose carrot that's dangling is so attractive that they'll just keep trying. The whole purpose of blockchain is to bypass the intermediaries and therefore the cost of intermediaries.
Yes.
That's such an attractive proposition that giving up on that, I can't imagine,
well,
right?
That's part of the productivity boosting growth journey that we're on right now, isn't it? You know, the use of technology that can improve the productivity and access to markets and cutting down the cost of doing business. So from that point of view, I think it offers a lot of economic and business attraction, absolutely. Bitcoin, I mean, we've seen massive changes in payments technology, and no doubt we'll see further massive changes in payments technologies. So, you know, the way that mobile phones and so forth are used.
It's here to stay?
Oh, absolutely.
Okay, it's here to stay. Will it impact monetary policy? Will central banks be spectators? That's another question from the audience.
Yes. Well, I think at the moment, Bitcoin is a very, very small part of the whole payment system. I think what's attracted people's attention is not so much, you know, the people in this room are probably thinking about the blockchain technology aspect of Bitcoin, but what's captured the media's attention and personal attention is immediate path to riches.
Right, the speculation.
The speculation. Yeah. So, I mean, my own personal investment philosophy is if I don't understand something fully, I'm not going to be invested in it.
That's the expectation of my board as well. Funnily enough.
Yes.
All right.
So you can make your own choice there, but I don't think we should be dismissive of the technological background of all that. Absolutely, it's the way that things are happening.
All right, I'm going to change tact again unless we have another question on Bitcoin or blockchain. We do. Let me just ask that. Nick?
Bill Griggs, I'm from Super SA.
Hi.
Just want to follow up on the blockchain technology and the concept of coming up with a currency which is not a fiat currency, it's not run by a country, it's not managed by any countries. Sorry. The concept of a currency that's not a fiat currency, Bitcoin's not right, but the technology is impressive.
All right.
Most people in my family would say I could speak loudly enough. So, if there's a currency which is, well, very good. If there's a currency which is not a fiat currency, not run by a sovereign country, and therefore there's no ability to print more money, what happens to central banks?
Of course. Interesting question, right? It's real futurist stuff. We don't know how quickly these things are changing, you know, potentially before our eyes. So, you know, will we have some other different world that we don't understand the way that it quite works right now? I mean, the reality right now is that central banks are still running the show, but a lot of technological changes is happening. So I don't have a nicely neat packaged answer for you. I mean, I think central banks have got enough issues on their hands with dealing with this world of low inflation and whether they need to increase interest rates too much at all at this point.
All right, thank you.
But it's a great question.
Could I just change tack yet again? And there's been a question from the audience about trade wars, and it initially points to the trade war that the US may initiate. Be interested in your view on that. But assuming that there is protectionism, increased protectionism, and therefore down the path of a trade war, could Australia benefit from such a trade war because of its relationship with China, or will there be an overall drop in global trade which would hurt us as a consequence?
Yeah, it's that's a big question, and we don't know what the consequences will be until we see how actually things unfold on that front. Specific measures being undertaken. Was this simply a ploy by the US administration to build some political support in Pennsylvania, you know, with the congressional election there this week. Actually, I haven't followed up. Did the Democrat end up winning that?
I think I saw something in today's Fin Review that said it poses a problem for Republicans, so I'm guessing the Democrat won.
Yeah. So if that's the case, and we know there's a lot of backgrounding that happens between high-level people in the US and China and elsewhere so that they understand more fully what's going on. But nevertheless, to this point in time, it looks like it's sort of being contained. Is it just a short-term political thing? But I wouldn't want to dismiss things. I just think we need to see how this develops. Would we benefit from that? Clearly, by definition, if it's sufficiently large to have a material impact on global confidence and business confidence and growth, that's not going to be good for us. So, you know, we rely on access to markets as well. So, how's that going to affect our relationship with China and our other trading partners? So, my way of approaching this is to think through those sorts of issues, what's been announced, what might happen. So, to date, it's been more at the margin. Australia's been exempted from those US tariffs.
And criticised by our neighbours for taking up the exemption rather than fighting for the principle of global trade.
Yes, understand that, but business is business, I guess, at the end of the day. So, that has domestic politics tied in with it as well.
Okay. Can I, turning our attention to the economic consequences for investment markets and for politics, where you have a divergence, a question from the audience, where you have divergence between business conditions and households, is that likely to create more inequality, not just in Australia, but globally? We've already seen that in some parts of the world, but in Australia, is it likely to create more inequality and, as a consequence, political backlash? I mean, for example, do you ever envisage seeing hashtag don't pay your mortgage?
Yeah, no. I think definitely, when I was looking at, I grew up and did my apprenticeship in an era when the wage share of GDP was at an all-time high. In the early 80s, the Metal Workers Union, won, I think, an 8 or 9% wage rise. All of the changes that happened in the 1980s. And here we are today with the wage share of GDP at near an all-time low. That's what we spoke about, how this has been a business recovery. Absolutely, that does have political repercussions. I think that resonates in Canberra, and of course the government is under a lot of pressure to reduce tax rates at a time when we can argue about the extent to which they have the fiscal capacity to do that. I mean, Australia's debt to GDP is quite moderate, at 30% of GDP. But, they have this obligation, this promise to get the budget back into surplus. But at the same time, the political imperative is to cut company taxes, but also a lot of talk about personal income taxes. So I think it's going to be very interesting to watch that in the next budget. And I wouldn't be surprised if tax cuts is a sort of a feature going into the election next year as well. And we're already seeing some of those lines being drawn right now.
Well, no, absolutely. Just on that note, so the opposition policy, I'll try and get an opinion out of you for this, but the opposition policy of restricting cash payments in lieu of dividend imputation credits for a certain number of people in the economy, is that good policy or is that good politics, or both?
Look, there is politics in that. I would wish that if we're going to make changes to the superannuation system, I would have thought there's a good case to grandfather people. If they're within 5 to 10 years of retirement age, the last thing is you want the rules of the game to be changed as they approach retirement, if it requires a big change in strategy and direction for those individuals. The politics of it, Sam, are that they want to be able to use those funds for other reasons, right?
For personal tax cuts, for example.
Absolutely.
Yeah.
And so there is always that discount factor involved in that. So how that washes out, it's going to be very interesting. So
Okay, as we...
that's as far as I probably...
All right, fair enough, but I'm going to get something else out of you if I can. There's been a whole set of questions from the audience, basically begging a prediction in interest rates,
Yes.
how much, when, currency, and whether you see any black swans on the horizon,
Yeah.
and if so,
Okay,
what are
interest rates, the market has already made its bet on which direction it thinks interest rates is going in Australia over the next 12, 18 months to 2 years. So the market has a slight tightening bias. So that's reflected in wholesale rates today. It's not massive.
25 bips, 50
Yeah,
bips?
something like that. I think that unless we're surprised and see wage inflation pick up, which doesn't seem likely in the short term, the Reserve Bank is going to be pretty cautious, I would think. So our house view is that, just to be absolutely clear, our house view is the Reserve Bank could come back as early as come into the market as early as this year. One thing we have to be careful of with the Reserve Bank is it's not just the wage inflation point and the consumer, the CPI. The Reserve Bank of Australia is much more sensitive to asset prices than other central banks are. So that's where the low interest rate story and the valuation story comes in. And while we've got such fast growth in population, I think we're going to see this housing cycle extend. My suspicion is that the housing cycle is going to be extended even further. Does that mean that house prices get another leg up at some stage? I think, you've got a lot of supply restrictions. The RBA's done a lot of work on the impact of zoning restrictions on house prices and the like. So we're seeing that on the street right now. So it's going to be interesting to see how that develops. But I think my expectation is that at least initially the Reserve Bank's going to be pretty cautious, but they still think that a 1.5% cash rate is at a quite accommodative level. In other words, it's supporting and it's providing a lot of support to the economy. Is it at the right sort of level?
Right,
the level matters as much as the change.
So reasonably small nudges to Australian interest rates in the next 12 or 18 months or so. Okay.
And I think the global cycle is turning that way. It has been turning in that way. Yep.
All right. Can we just turn our attention to currency? It's always good to ask an economist to make a currency view.
You want a 24-hour view or a 48-hour?
The next hour will be fine. So this is pretty much, we're in wind-up mode now. So the US interest rates are going up. That normally causes money to flow into the US, causing the US dollar to appreciate, causing the the relative move of the Aussie dollar to fall. That would be music to the Reserve Bank's ears, right? Is that the scenario?
So that's been an important element of it. The positive carry on Aussie has disappeared. So as of today, or as of yesterday anyway, the carry on 2-year was negative 26 basis points, rather than 350 to 400 basis points 5 years ago. So that's been a headwind for the Aussie, but the US dollar seems to be running out of steam. So I think markets are looking at, you've had the Brits increasing interest rates, you've had the Canadians increasing interest rates. So it's not just a US story, there's a lot of speculation about negative rates in Europe, whether they're going to be starting to be lifted. So that's been the headwind for the Aussie, the negative carry. The positive headwind has been the commodity price story, the China story, and I think a lot of people have been surprised with that. So let's see how those things unfold. We're not super bearish on the Aussie dollar. There's a lot of exporters that'd love to see it 65 cent Aussie, but here we are, it's 78 cents.
Okay, right. And then finally, can we just wrap up with black swans? Do you see any, albeit low probability, but events that could surprise to adversely impact?
The trade thing is something that we're going to have to watch pretty closely, I think, Sam. By nature, black swan events are unpredictable events, right? But big, low probability events with big negative payoffs.
Okay,
right?
so Yes or no?
Yes.
Fragmentation of Europe.
I'd say no. On the 12th to 24th.
Nuclear war.
Nuclear war, no.
Cryptocurrency collapse causing people to cry.
I'm not so definite on the no there.
All right, we have run out of time. Can you please join me in thanking David for today's contribution? Thank you, David. Now we do. Please rate the session. Click feedback on your app, and I think we are about to wind up for morning tea. Thank you to First Nations for donations been made to First Nation Foundation on behalf of our speaker today. So thank you very much for participating. Morning tea in the Central Hall, proudly supported by our premium partner, Inside Investments. Thank you.